required to respond to the auditors, etc. So now, from the regulator side, I would like to inform you that penalties have been increased in the Act like anything. So while certifying anything or keeping in view the compliance, we have to ensure that we do not cross the limit prescribed in the Act. Now, if you see charge documents, because we all are concerned, specifically the auditors, that companies have to file earlier Form 8, now the new form has been prescribed. Charge form for the creation, modification, or satisfaction is to be filed. Now, up to 270 days, ROC have the power to basically to regulate the penalties, and that is as per the table. But beyond that, the penalties is much more. It's minimum 1 lakh rupees. So we have to be very careful while doing the documents, etc. And we should advise the clients that they should upload the forms within the time limit prescribed. Filing of the documents, etc. also. I can only request you that once the audit is over, the chartered accountants can advise to the companies to upload the documents as early as possible. They should not wait for the last days. So compliance part is there, that we have to ensure that yes, the documents are filed well in time. So with these words, I would like to convey my thanks to the chairman EIRC for calling me here. And of course, opportunities are there. We all have to learn. And I wish all the best for the next 2 days to learn and learn. Thank you very much.
Thank you, sir, for your assurance, and we know that under your leadership here, we had a very good time, and will continue to have good time during this transition. Thank you so much, sir, for being here this morning and sparing time among your valuable schedule. Ladies and gentlemen, we are coming close to the session. May I request my Vice Chairman, P.D. Rungta, to please propose a hearty vote of thanks to the speaker, to the guest.
Respected Dr. Saini, thanks for eagerly accepting our invitation and coming to this morning for this session. And may I request Richa Banka, please come forward. Richa.
Ladies and gentlemen, I'm extremely sorry, sir. This background material to be released by our chief guest and our Central Council member, Vice Chairman, and Sumantro Goen of Vijayda. Please do, and after that, vote of thanks. Gentlemen, this background material will be given at your respective chairs, please, so don't worry on that.
So thank you, sir, for sharing your thoughts with us. And may I request Richa Banka, please come forward. Richa is here. May I request Sagar Jain ji, please come forward. Sagar Jain. Please present a memento to Dr. Saini. Friends, please carry this vote of thanks with a big round of applause. Thank you. Thank you, Richa. And thanks to all three Central Council members for allowing us to conduct this seminar and the aegis of the committee and sharing their thoughts over here. And may I request Neha Chaudhary please come forward. Neha is here? Yeah. Neha, please come forward. Present a memento to CA Nilesh Vikram Singh. And may I request Solaki Patodia? Solaki? Present memento to Shumantra Guha. Thank you. Thanks to all of you. And friends, please don't move. We will be starting the first technical knowledge session immediately within 2 minutes.
Kushrubi Pantaki, as you all know, that he has been in the profession for more than 30 years. He has good experience in accounting, auditing, and business advisory services within the profession. He is currently a senior partner with Walker Chandiok and Company, renowned LLP. He has extensive experience both locally and internationally in auditing, advising large corporates and multinationals. He has extensively specialized in BFSI, particularly in the insurance industry. He has also completed a diploma in insurance from Darden Business School in Virginia. He is an eminent speaker in many workshops, seminars, conferences, locally and internationally, and has presented technical papers in India, Singapore, Hong Kong, United Kingdom, and USA on varieties of subjects. He is a visiting faculty at the National Insurance Academy in Pune, and he is invited by other management institutes in India to address on various topics. With these, ladies and gentlemen, please join me in giving a big round of applause for CA Kushrubi Pantaki. And I would request CA Sagar Jain to please come forward and offer a flower bouquet to our learned speaker, CA Kushrubi Pantaki. Sir. A big round of applause once again, please. So with these, I would request the speaker for the day to please, start his presentation, and let us, give respect to the theme given by our chairman, fly high, and we can fly high only if we have a supersonic speed. So ladies and gentlemen, I would request you to, please cooperate with the speaker, give, adequate time for the presentation, and then if you have any queries and all, please, raise your query so that, it can be addressed in a right manner. Thank you very much.
Very good morning to all of you. At the outset, I would like to thank EIRC for giving me this opportunity of coming and sharing with you some of the important developments of the Companies Act in relation to corporate governance. And therefore, you could see the theme of my subject being called as corporate governance in the new regime. Friends, it's always a pleasure to be addressing our professional fraternity, because I always believe that knowledge has to be shared. And when I see a good number like this, especially on a public holiday, it speaks for the fact that, yes, people are interested to learn and to get up to speed with the new provisions. For a long time now, we have seen that Companies Act has been evolving, but the sections were not notified. And even when the Companies Act was evolving, at that point of time, there were different interpretations and there were different deliberations, as a result of which things were not clear. But good amount of sections have been notified now, as a result of which the Companies Act has become the law of the land to a great extent. We heard some of the speakers in the morning mentioning that some of the sections are yet to be notified, and therefore it's only a matter of time, after some problems have been addressed, that these sections will be notified. Times are going to be different, times are going to be challenging, times are going to be difficult. I'm not scaring you, but yes, again, it's a learning procedure. And the other day when I was trying to put my hands on the Companies Act, I started reading it from page 1. So then it reminds me that yes, either I'm giving my inter-CA exam or I'm giving my final CA exam. It's something very similar to that, because we all are required now to go through each and every page. Many things have changed. Some things have changed for the better. Definitely some of the provisions have been well thought of. They have been really structured in the right manner. And again, with due respect, some provisions are not so friendly for the profession. Some provisions are not so friendly for the investors. But we believe that over a period of time, through some clarifications and through some circulars, these will get addressed. Our institute is playing a very good role in ensuring that some of the rest of the provisions which are not yet notified are clearly understood by the ministry. Once they are understood by the ministry, I'm sure there will be some corrections and the rest will be notified as well. Before I get into a technical part of the presentation, let me dwell a little bit on governance. I think the real form of governance always existed in the organizations, even in the past. But that could be by form and not by substance. And we all know exactly what happens when something is in form and not in substance. Having a checklist, having a sign-off is a form. Implementing the things required in the checklist and seeing the practical aspects of it and ensuring a good governance framework in reality is something very different. Over the last 14 years, ever since corporate governance became the law of the land in 2000, I have seen that the norms of governance have improved. But India is still lagging significantly behind. And I can tell you, because of the fact that I have worked in firms in the UK, in the US, for a long period of time, and I can tell you that we are far behind. There's nothing wrong in saying that, but we are far behind where the governance is concerned. And therefore, Companies Act 2013 should now become one of the important footsteps to ensure that we scale better heights of corporate governance. So today, I'm going to cover a little bit on governance, and within the governance itself, what are the requirements to have committees of the board? What is the report of the board which is required to be presented? What are the related party transactions? And what are the other important provisions under the Companies Act where governance is concerned? But just before we start the governance, and since I am the first speaker for this particular technical conference, let me highlight some of the important benefits and some of the important results that we will achieve out of the new Companies Act 2013. The very first thing is the transparency. There is a lot of transparency now in the way in which the organizations are going to function. The directors are going to be appointed and the decisions are going to be taken. So that's definitely a wonderful step in the right direction. Most importantly, the Act also ensures that there are protection measures being there for the investors and the minority shareholders. Because people like you and me are retail investors. There can be promoters with 70–80% of the stakeholding. But then when minority interests are concerned, they need to be safeguarded, because your hard-earned money and my hard-earned money should not be lost on account of lower levels of governance. And therefore, Companies Act ensures that there is a good protection of minority interests. Instituting good corporate governance norms by having independent directors, by having whistleblowing mechanism, by having a risk management framework would definitely bring in corporate governance to the next level. So CSR initiatives have been introduced. The corporate social responsibility is something that has been introduced now. And let me say at the outset that we should not think that corporate social responsibility is mandatory on the companies. No, it's not mandatory on the companies. Either the companies have to contribute to CSR, or in case if they are unable to do so, then they need to explain and they need to write in the report as to why they were not able to initiate corporate social responsibility measures in the current year. So it's not mandatory, provided there is an explanation given for that. One of the important developments under the Companies Act is greater responsibility on the auditors. Auditing profession is becoming difficult and difficult. There is going to be much more in terms of restriction on the number of audits an individual can do, restriction on the number of audits a firm can do. Rotation of auditors is becoming mandatory or is already mandatory. And at the same time, if the auditor has been negligent in ensuring conduct of a good and an efficient audit, then the punishment is very severe. The disciplinary committee is no longer going to be deciding on the auditor's future. Currently, although the section is not notified, NFRA will be the deciding body on the fate of the auditors. So that's again something which is going to be introduced, and therefore audit profession needs to be seriously taken up. And as somebody was mentioning in the morning, I personally believe as well that if we do not do the audit with the kind of rigor and with the risk-based approach that we are required to do, things are going to be much more difficult. You know, gone are the days when we used to do the audit under the transaction-based approach by ticking the numbers and by tallying the numbers with the vouchers and seeing the general ledger and looking at the trial balance. That's not the way companies and the board of directors expect the profession to carry out the audit. It's a complete risk-based approach where you need to understand the industry in which the company is there. You need to understand the business of the company. You need to make sure that you evaluate the internal control framework, because again, that is something that you are required to report additionally in the audit report. And then you are giving a true and fair view. So it's a complete risk-based approach and not a transaction-based approach, which many of us in the past have adopted. Some of the corporate regulations have been very investor-friendly and business-friendly as well, and therefore that's a welcome change in the Companies Act. Some of the e-governance measures, you can do a lot through e-governance. You can file a lot of forms with the Registrar of Companies and with the Ministry of Corporate Affairs electronically, and therefore a good amount of time is wasted. A lot of corruption will come down as well, because now you are going to do through e-governance as well. And definitely it's going to improve the accountability in the corporate sector of India. So some of the benefits which are highlighted are really, really going to turn around the corporate, I would say the corporate vision, the corporate world over the next few years, provided that they are in substance and not in form. Coming to the governance, which is basically under the new regime, why did the ministry felt or the law change to ensure better governance? I think we all have a responsibility as corporates towards the internal and external stakeholders. When I talk about internal stakeholders, I mean employees and other people who work for the organization, and external stakeholders, which are your creditors, which is the government, which are the shareholders, etc. So everybody has a responsibility towards internal and external stakeholders. By having good governance, you have an easier access to the capital market. If your company is reputed, if it is a good image, then it's easy to have accessibility to the markets as well. Global competitiveness is also ensured through good governance measures, because now through the global competitiveness, you are creating a lot of trust between the investors globally and the company. Governance also promotes a good amount of corporate fairness, transparency, and accountability, which I spoke about it earlier. Risk management will also improve, because now the board of directors are responsible to ensure that there is a good risk management framework within the organization. So what is important over here is that there should be an enterprise-wide risk management framework prevailing in the organization, where every key process owner For example, in every company, there are different departments, different functions like operations, sales, distribution, HR, admin, finance, production, a lot of these. They need to ensure the extent of controls prevailing in that department are of the highest order. They need to make sure that those controls are properly designed, they are operating effectively, and that they are adequately monitored. And on a quarterly basis, at least for the listed companies, there is a compulsory sign-off on the prevalence of those controls. And then, from all the various departments, it comes to the CFO or the finance director of the company, who would then sign off on the financial reporting process. And then the CEO will sign off on the entire enterprise-wide risk management framework, and the entire sign-off is then tabled at the director level or at the board level. Now, this is the EWRM or the risk management framework a good governance would expect. But you and I know to what extent this can be in form, this can be in substance. I'm not trying to be critical over here, but this is something that is expected. To what state it prevails, I think time will show that. There is a lot of rationalization and disciplining in the decision-making measures, because now no one man is going to take the decision. A promoter cannot take the decision on his own. There is a process, there is a review mechanism by the audit committee. The report then goes to the board, and the board will have to decide along with the other independent directors who are being part of the board. So it's a good governance by ensuring decision from all rather than a few. And finally, all these things are done with only one intent: to make sure that your operations are run well and they are run with complete efficiency and effectiveness. So these are the reasons why you need to have better governance within the organization. Now, why do we talk about improving? Why do we think that, we did not have good governance? The reason why we did not have good governance is something went wrong in the past. And we know internationally what happened to Enron. We also know within India how many frauds had been created in the past, as a result of which it reflected on so many. As a result of which the governance had to be tightened. So there were many frauds internationally in the US, in Europe, and in India as well. Some of the compensations being paid to the executive directors and the board were completely not proportionate to the kind of efforts that they were putting in and the kind of business that the company was generating. People were drawing remuneration that the way they want to, and therefore under the new governance norms, there is a committee called Nomination and Remuneration Committee, which will decide about the compensation of each and every director, depending upon the skill sets, depending upon the performance, and depending upon how much he brings to the table, which is really very good. Misuse of corporate funds. Corporate funds are being used for anything and everything. Now there is going to be a tighter control on that. Insider information. I am aware of the fact that the results are going to be declared over the next few days. I would start garnering the shares of the company because I know that the results are very good and the stock market prices are going to go up. So many people were holding shares in the company and sitting on the board of directors. There could be, although it's not required, there could be individuals interacting with the company and making a profit out of the insider information. And therefore, there is going to be a restriction now as well in terms of ensuring that people do not make unjustifiable profits out of the insider information. Misrepresentation of true earnings and financial conditions of companies. It's always said that when the companies are not performing well, there is a better risk or a higher risk of a fraud, and therefore companies can report results which can be misstated. Now there have been enough punitive measures, enough penal actions initiated against the company, and including the auditors, if the auditors are involved or collide in ensuring that there is a fraud. And where auditors are concerned, somebody will take it up later as well, that if at all it's proven that the auditors were forming part of that fraud exercise, the penalty on the auditors can be equivalent to 3 times the size of the fraud. So if the fraud is worth 10 crore, the auditor can be punished up to 30 crore. So I'm not too sure how many insurance companies are going to cover or provide professional indemnity to auditors in the event that this thing happens. And finally, obstruction of justice by concealing the activities or destroying evidences. We all know that, when something goes wrong, evidences are going to be destroyed, justice is going to be obstructed. So there are enough norms being created through independent directors and through proper representations on the board to ensure that these things don't happen. Getting into the real substance of this presentation, we will talk about the board of directors now. And as somebody was mentioning earlier, it's mandatory to have one woman director on the board for listed companies and for certain prescribed companies as well. Now, it doesn't mean that that woman director has to be independent. She can be an executive director, she can be a non-executive director, she can be an independent director. So one woman director is mandatory. And the other requirement is also to have one resident director. The genesis of this is the fact that in India, there were many companies which were subsidiary of foreign companies, 100% subsidiary of foreign companies. And there were two directors in that particular company and nobody was a resident in India. When it comes to governing that particular company, running that company, nobody could sign off on any document. As a result of which, it was decided now to have one resident director in the company, which is again a good move. Some of the companies, and when I talk about the prescribed class of companies, I will come later on the next slide as to what is the kind of these companies which are called as prescribed classes of companies. So certain prescribed classes of companies are required to have a whole-time key managerial person, including the managing director, a CEO, a company secretary, and the CFO. Now look at these positions. Again, this is a step in a very good direction. You cannot run a company with a certain size without the CEO, without the managing director. He can be a MD and a CEO together, as long as he's leading the company. You need to have a chief financial officer or somebody who heads the finance of the company. You need to have a company secretary to ensure compliances. And therefore, that individual has to be a whole-time as well. And therefore, automatically, that company can be better run than what it could have been without these individuals. In case if the director is resigning from a company, then the registrar of companies has to be informed along with the reasons for the resignation. Now let's take I will start giving you some practical examples because I have been in this profession for 30 years now, and I have been a part of the audit committee discussion and the board discussion over the past 15 years, because right from 2000 or 1999, the audit committees had started. And I have seen different kinds of audit committees functioning in a different manner, with a complete different mindset as well. Many of the independent directors and many of the executive directors are very quiet in the audit committee just because of the fact that they don't like it. After the audit committee is over, they would want to resign. But nobody would know why they are resigning. They are not being asked. Now, a director resignation has to be intimated to the registrar of companies along with the reason. But again, I'm not sure over here to what extent that reason would be a genuine one. I may resign on account of the fact that I'm not trusting the financial performance of the company. I believe that there is a complete misstatement in financial reporting. But in my reasoning to the ROC, I may say that I have no time and I would want to resign. So again, this is in form. But how much it is going to be in substance, again, is a matter of time. Academic and professional qualifications are also going to be prescribed now for the audit committee members, which is very good, because anybody and everybody cannot be an audit committee member. I have seen two types of audit committees. One, where you have fantastic people who question the auditors, who question the management, and even the auditors